There is a number that can switch off the entire United States stock market. Not one exchange. All of them at once. That number is 7%, a 7% fall in the S&P 500 below the previous close. There are two more above it, 13 and 20, and each does something different. Almost nobody can say what. So let us build the break piece by piece, and then look at the 4 days it actually fired. The payoff first, because it reframes everything after it. A trading halt does not cancel selling pressure. It parks it. Orders keep arriving into a stopped book, and when the market reopens, it does so through an auction that has to clear all of them at one price. So a circuit breaker is not a shock absorber that makes the energy vanish. It is a pause button that changes when and how the energy gets released. That single fact splits the entire academic argument in two. One camp says the pause buys time, margin clerks get to call, humans get to read, and the panic decays. The other camp says the approaching threshold acts like a magnet, because anyone who needs to get out would rather get out before the doors close, which accelerates the very move the break was designed to slow. Both mechanisms are real. Which one dominates on a given day is the open question. A little history, tightly. Market-wide breakers exist because of one day, the crash of 1987, when the market fell so far so fast that the machinery for handling orders simply could not keep up. The first generation of breakers was built after it. The version running today is the second big rewrite, and it took effect on the 4th of February, 2013. Two things changed in that rewrite, and both matter for exam-grade precision. First, the thresholds came down from 10, 20, and 30% to 7, 13, and 20. Lower triggers means the break is meant to engage earlier, not later. Second, the reference index changed from the Dow Jones Industrial Average, which is price-weighted and holds 30 names, to the S&P 500, which is far broader. Then came the test. In March 2020, the Level 1 breaker, the 7% one, fired 4 separate times on the 9th, the 12th, the 16th, and the 18th. 4 halts in 8 trading days on a system that had never fired since the redesign. So the rules are not theoretical. The question is what actually happens in those 15 minutes and why the answer changes after 3:15 in the afternoon. Now the mechanism, one block at a time. Block 1, the market-wide break. Each morning the exchanges compute 3 price levels from the prior day's S&P 500 close. Down 7%, down 13, down 20. If the index touches -7, every United States equity market halts together for 15 minutes. -13 does the same thing again. -20 is different in kind. It closes the market for the rest of the day, whatever the hour. Block 2, the clock. And this is the detail most explanations skip. The 15-minute halts at levels 1 and 2 only apply before 3 in the afternoon Eastern Time. After that cutoff, a 7 or 13% decline does nothing at all. Only level 3 still bites, and it ends the session. So in the last 35 minutes of a bad day, the market is effectively running with a single break instead of 3. Block 3, the second system, which is per stock and runs continuously underneath. It is called limit up, limit down. For a tier 1 name, the S&P 500, the Russell 1000, and selected exchange-traded products priced above $3, the band is 5% around a rolling reference price. Trades simply cannot print outside that band. If the best quote sits pinned at the band for 15 seconds without the market trading back inside it, that one stock halts for 5 minutes. Block 4, put the two together. Limit up, limit down handles the single broken name, a fat finger, a bad print, one collapsing company. The market-wide breaker handles correlated panic, where everything falls together and no individual band can catch it. In March 2020, both were firing at once, hundreds of individual band halts underneath 4 market-wide stops. And now the asymmetry that reveals the design philosophy. The market-wide breaker has no upside twin. There is no rule that stops trading because the index rose 7%. Limit up, limit down is symmetric. It has a limit up as well as a limit down, but the big break is not. The people who built it were not trying to stop prices moving. They were trying to stop a specific failure, a disorderly decline outrunning the plumbing that settles it. So what did it feel like when it fired? March 2020 is the only real sample we have of the modern system under load. 4 level 1 halts, the 9th, 12th, 16th, and 18th. Each one froze every American equity venue for 15 minutes. Underneath them, hundreds of individual stocks were tripping their own 5-minute band halts. Consider what that does to the people who have to act. A risk desk that needs to hedge cannot hedge while the market is stopped. But the exposure keeps changing because futures and options on other venues do not all stop in the same way. A fund facing redemptions cannot sell, but the redemption requests keep arriving. A broker's margin system keeps marking positions against clients who cannot trade out of them. The pause protects the settlement machinery, which is exactly what it was designed to do. It does not protect any individual participant from the move. That is the honest summary, and it is why the working group that reviewed the system afterwards spent most of its attention not on the thresholds themselves but on the reopening the auction that has to absorb everything the halt collected. One line to keep: the break does not remove sellers, it cues them, and after 3 in the afternoon, 2 of the 3 breaks stop existing. Everything else follows from those 2 facts. If you ever watch a session go badly wrong, the useful thing to know is not the 7% number by itself. It is which clock the market is on and what the reopening auction has been collecting while trading was stopped. Here is the forward question. The system was designed for correlated selling in a market of humans and phone calls. Most volume now comes from systems that can measure their own distance to the threshold in microseconds. Does a break that everyone can see coming still slow the car, or does it steer it? If you want more of the plumbing under the price, subscribe. Educational content, not financial advice.